Are you a freak in the sheets and you love Excel? Because if you do, you're in the right place. We're gonna break down one of our real commercial real estate deals and how we underwrite them with my man Will right here, our analyst at Hungry Investments. So stick around because rent's due. Welcome back to the channel, guys. I'm Christian Cotta with Hungry Investments, and today I'm joined with my friend Will Hahn. Will Hahn is our analyst here at Hungry Investments, and we've been working on something that we wanted to bring you guys for quite a while. So Will breaks down every single one of our projects that we do here at Hungry Investments. When I say every one, I literally mean every one. And so I asked Will if he'd join us in the studio today so we could actually walk you guys through one of our live projects, and that's what we're gonna do. So Will, introduce yourself to our channel.
Yeah, hey guys. So this is Will. I've been in the commercial real estate for 5 years at this point. And with my background in financial modeling, I've been helping Christian build out the models for his ground up developments and his build to suit projects.
And so if you go to our website and you go to our About Us and you see this guy's sexy mug, it says Chief Financial Analyst because that's what he does. So he builds our spreadsheets, which we want to walk you through, and we want to help you guys understand how to break down your projects using one of ours here live. And he makes it to where I can go through and I can underwrite and do all of our pro formas on every single deal. And trust me when I tell you, we use this thing multiple times every single week. I literally get with Will once a week just to go through and make sure that I didn't screw anything up. But overall, these sheets are exactly how we determine whether or not we want to move forward on a project or we want to pass on a project. So Will, let's start. Why don't you kind of walk through and give the lay of the land?
Yeah, sure. Hey guys, so I'm gonna give you a brief overview of the model. So up here, we have a general information about the property, including the property address. For now, we're gonna put simple property. And we have the purchase price, the size of the property, and what that translates to in terms of price per square footage. And then right here underneath, we have our construction cost and it's all the soft cost, hard cost, and other legal costs potentially that goes into the project. And some of the other pieces like the development fee, the leasing commissions, and any reserve that needs to be held. And this one, we're putting 0% for now, just because all the costs are included up above. So make sure when you guys do your deals, make sure to include some reserve up there. And then we have the timeline here. Let me move this over a little bit, where we have the sale month, how long the project is going to be, what kind of loan we're working with, and then what that translates to in terms of the capital raise from your investors or through your partners as well. And then on the right here, we have what the development itself is going to support. So for this one, it's going to support the QSR retrofit, and it has all the details that goes into the valuation for this project. So including the square footage, what the yearly rent is going to be, what that translates to in rent per square footage, what kind of leasing commission we need to hold for the broker when we sell, when we lease out actually, and the low sale cap rate and the high sale cap rate, so that we can both look at a conservative and an aggressive approach in terms of the sales price.
And so this is our built-in sensitivity analysis.
Correct.
Based on what we know our current market or the market that we're looking at the project in, what the cap rates are on a high cap and a low cap. If you want to see a full sensitivity analysis report, we've got a free one that you can download. The link's below in the video, and you can also go over to our website at hungry-inc.com. I'll let you get back to it.
Yeah, thanks. So lastly, we got our sales assumptions based on the low cap scenario and the high cap scenario that we just talked about. And then we got to take out the sales cost, some of the tenant improvement allowance, and the loan payoff, which translate to which we use to calculate the sales proceeds, how much we have left. Then based on the agreement that you have with your investors, we'll go through what kind of equity split you have between the GP and the LPs, and what kind of return that translates to in terms of percentage and raw dollars for the LPs, and finally for the remaining returns for the GPs as well. So that's a brief overview of the model, and now I'll pass it up back to Christian to go over the actual deal.
So real quick before we jump ahead, So this is where all of your data, your decision-making data is gonna go, right in these two sections. All the other stuff that Will just showed you, That's where all your due diligence, your market analysis, your knowledge of the property and what you're doing with the property, the importance of making sure these numbers are correct comes from making sure that you're correct, plugging in your numbers in those other areas. So we'll get to this here in a second. I'm going to give you a brief overview. This is a real deal. Obviously it says sample. Let's scroll up real quick. So this particular project, what do we have here? This is a QSR retrofit. So what we did here is this is a property that we found that was an existing building. It was a former QSR quick service restaurant, an old shut down drive-through, restaurant building that you probably have seen all over wherever you live. We targeted this site. We had a tenant in mind. So we went and we negotiated and we put the property under escrow for $2.2 million. It sits on roughly an acre. We know that when we go into this property, we're gonna utilize the existing building. It's also only one tenant, so that's why you only see one tenant, but we have placeholders in case you're looking at a bigger project. The way we break this down is we're estimating, right? So this is a more detailed back of the napkin type of analysis. We plug in roughly $30,000 from miscellaneous legal. That includes, negotiating the contract, title review, anything that we might need to do during our escrow period, the leasing, legal for leasing, negotiating with our tenant. We have architectural and engineering. So this particular project, the building as it sits doesn't have a drive-through. So it was a fast food restaurant that didn't utilize a drive-through, but the property can accommodate a drive-through. So we've got architectural and engineering for the drive-through, and then we've got construction of the drive-through that's about $100,000. Now we go down, we look at our other costs. We can't take into account that we're gonna hold this for a period and there's gonna be taxes and insurance. So we plug in roughly $15,000 for taxes and insurance. Gotta have a contingency. Can't go in and think that I got this whole thing pegged down right the first time. So $50K for contingency. We plug in our closing costs, estimated $55,000. And since we're the ones doing the work, even though we're raising the capital and we're gonna make money on the back end, we're a development company. So the amount of knowledge, expertise, we plugged in, roughly $150,000 for a development fee. But depending on your situation, your experience, all of that stuff, you don't have to put anything in there. It could just be a straight 50-50 with you and your buddy that's putting up the money, a group that family, friends, whatever. This is completely up to you. City approvals, roughly $10,000. Now this particular tenant that we're releasing the project to, we have to give them, it says build-to-suit contribution. This can go either way. It could be a build-to-suit contribution. In this case, it's a tenant improvement allowance. It still accounts for it the same way. So we're giving the tenant, when they open for business, $700,000 towards the construction that they put into the existing building. We're taking our development fee up front, and as Will said, we could plug in here construction reserve. We don't have a lot of construction on this project, so it doesn't make sense. We're only putting a drive-through in. Let's go up a little higher here. You can see right here, like we said, if we had multiple tenants, if this was a larger site, we might have 2, 3, 4. We do have some projects. We'll film some of those for you guys. This section right here, we've gone out. We have relationships with our lenders. We know what some of those lender relationships are. It's roughly 70 to 75%. We plug in what we need there, where our interest rates are, loan points they're charging us. All these blue items, you can change all that stuff. That's what he does, makes it real easy for somebody like me, so I don't screw this up. I don't touch anything that's not blue. If it's blue, it's you. So that gives us the total capital raise. And it tells us that we need to go out, because based off what our lender will lend to us for this type of project, we got to raise $805,000, okay? Roughly. I mean, you can raise 810, 800, whatever. Find some change in the couch, do whatever you need to do. But it's going to be in the ballpark, okay? Now, with that, that's going to help us figure out the rest of our returns as we go down. And this is where you can decide, do you want to go forward or do you want to pause? So when we come in here, we're taking our sales price. So we've got our low cap and our high cap. That's the sensitivity analysis that Will was showing you. I don't know what market you're in. We're in Phoenix. Here, I know that depending on the type of tenant, the tenant we have here, super high credit. Investors are willing to pay much more to own one of these properties because it's mailbox money. They feel safe, they feel secure. So we know based on those cap rates that our price point's gonna range from 4.6 to 5.1. That changes things, right? We're rounding, we're taking out our cost of sales. There was no construction reserve. Here's our tenant improvement allowance, and then we're paying off the loan. So we're left with 2 million to 1.5 total proceeds. I know you might be saying, hey, that's a big range, but what we really look at is the high cap, the worst case scenario. Are we happy with what we're gonna get if it ends up going for the high cap? And in this case, at 1.5 million, I would come down and I would look here, and I'd talk about this with Will. For the amount of work that we're doing, are we okay as the GP making $358,000? This particular deal, this tenant, the relationships we're bringing, probably not. So, I mean, I know they're putting up $800,000, but we're going out and getting the debt. So Will, plug in here the investor getting, call it 25%. So you can see now, if I give the investor that puts up the $800,000 a 25% split for this tenant when we sell, they're still gonna make a 22% return. We're gonna make $537,000. That's more likely what we're willing to do. But the reason I show you that is because this is completely up to you, and that's why having these underwriting sheets, these spreadsheets, for the type of deals we do, lets us sit here and figure it out. If you're sitting there with one of your investors, an investor says, hey, I want 70%, go plug in 70%. Are you willing to do it for $200,000? That's the question you have to answer. I can answer that for you. But because of the way that you built these sheets, it gives us a lot of quick
flexibility.
Yeah.
And you can play around with the model. As Christian was talking about, all of these is very negotiable with the investors that you are working with. And based on those conversations that you have with your investor, that's going to determine whatever investor return equity percentage is going to be. And one more thing that I want to highlight is the importance of sensitivity analysis, just like what Christian was saying. Just because the cap rate is such a sensitive metric in commercial real estate that even 10, 100 basis point is going to impact hundreds of thousands of dollars. So make sure that you are using a very conservative approach on the high cap scenario, whereas you could look at what your potential gain could be in a low cap scenario as well. And as Christian mentioned, we're gonna have a separate spreadsheet that has the sensitivity analysis that has a lot more tables that you can compare. So that'll be linked down below.
Let's just do this. Let's run the trap real quick, because you've built tons of these for multifamily, right?
Yep.
And when we first started working together and he started seeing the returns on the net lease on the retail side, you're used to seeing the LPs getting 70%.
That's right.
Right?
That's right.
So your asset classes are going to dictate what those returns and those structures are. Multifamily limited partners that put up all the money are used to getting 70%. On the retail side, it's different because it's very relationship driven. A lot of the work and the risk is taken out up front. So just for shits and giggles, go up to the top. Let's just change this because we know we've got a really good tenant that is going to get those cap rates. Go over to the cap rate and change this from 4.5 to 5%, and then change the high cap to 5.5%, and come back down and see if your investor tells you I need 70% and it's a net lease retail deal. Now you're making $90,000 over a year. And again, I don't know your situation. You might be okay with that. But what I can tell you is this is a lot of work to be done to make $90,000. Honestly, I'd walk away, probably. Or I'd go find a different investor. That's what I would do. So anything else we want to touch base on with them here?
No, I think we covered about everything.
Thank you guys so much. Make sure that you smash that bell, follow Hungry Investments so you get more commercial real estate insights, information, more of these videos. Me and Will are going to start now that we've got multiple projects that are coming full cycle that we can share more information. We'll actually tell you where these are located as they close out, and we'll do some more stuff so you guys can follow along. If you want to figure out, find out where to get these sheets, how to find these, make sure you hit all those links down below in the description. Click over, go to the website. Again, it's hungry-inc.com. Subscribe, like, smash the bell. My name's Christian Cotta with Hungry Investments. As always, rents due. Stay hungry, my friends. If you made it this far through and you landed here, it means you're serious about making money in commercial real estate. Don't forget to hit the subscribe button if you're not already following for more great commercial real estate, and check out this video or this video. As always, stay hungry, my friends.